The federal government's fuel economy proposal will raise vehicle prices at least $3,200 and as much as $5,000. An NADA analysis finds that these new rules will price 7.7 million licensed drivers out of the new car market. In addition, the economic impact due to job losses from dealerships to the factory could be staggering. The ultimate irony of all this is the proposal could delay future fuel economy, environmental, and safety gains. In this special report, NADA TV's John Spiropoulos details NADA's analysis of the proposal and its comprehensive and coordinated response to it on behalf of dealers and consumers.
The Obama administration proposes to set 54.5 miles per gallon as the fuel economy standard for 2025. That doubles today's fuel economy standard in just 13 years. NADA believes that's too far, too fast, and forcefully made its case on behalf of consumers and dealers alike during joint EPA-NHTSA public hearings in January.
From an association perspective, there were 3 hearings, and we wanted to be at every one to tell our story. And what is our story? Our story is that of the consumer. Will the consumer buy these cars? Will there be consumer acceptance of these vehicles?
New Mexico dealer Don Chalmers testified at hearings in Detroit on January 17th. Delaware dealer Bill Willis spoke at hearings in Philadelphia on the 19th. And Alabama dealer Forrest McConnell delivered the dealer's message at hearings in San Francisco on January 24th.
And what we wanted to do when we went into these hearings was to really give the voice to the consumer. We felt that the consumer's voice wasn't being heard.
To work, fuel economy rules must require improvements that are affordable. Why? Because you can mandate what the manufacturers must build, but you can't dictate what consumers will buy. If our customers did not purchase these products, we all lose.
Totaling the administration's final and proposed fuel economy mandates result in an average vehicle cost increase of at least $3,200, a substantial amount that every new car buyer will have to pay up front.
This would raise payments between $60 and $70 a month in a typical automobile loan.
They may not be able to buy what they need, so then the transaction just will not happen. If they can't afford it, we will not sell the new car.
Some tout that the cost of the proposal is essentially free because of fuel savings, but before any fuel savings can be realized, customers must have the ability to buy. For over 90% of Americans, the purchase of a new vehicle is contingent on getting approved for a loan or a lease. If they don't qualify, they can't buy. If they can't buy, they can't save money on fuel.
Higher prices will mean larger loan amounts. Some consumers won't qualify.
If a consumer can't FICO into the deal in the finance room, the sale is never closed.
Virginia Congressman and car dealer Scott Ridgell warns that it will cost sales.
If the initial price, which is going to show up on a payment, which I presented personally to literally thousands and thousands of customers at our stores, if that purchase price is prohibitive, it can be the safest vehicle, it can get 54.5 miles per gallon or more or whatever, and they'll just say, I can't afford it.
We've talked to the banks and they are not at this moment willing to just automatically loan more money on a car because it may pay back.
One question that NADA is asking, and no one else in America is asking, is if the price of the vehicles go up by $3,200, will the bank finance that additional $3,200 on the prospect of fuel economy savings? And the answer to that question is no.
I am unaware of any banker who will fund auto loans based on the promises of fuel savings. Loan qualification is based mainly on the income of the customer and on a vehicle price.
We think that is a shortcoming in EPA's financial analysis of this rule.
What's clear is this proposal will make it harder for many customers to obtain financing, eliminating their ability to realize any fuel savings.
Customers look at this based on the upfront cost. Customers, frankly, don't look at this on a payback over a multi-year period. They come to the dealership with an idea of how much they can afford and the type of vehicle that they need.
Customers that come in our showrooms today are in because they need a certain type of vehicle and they can afford a certain payment.
There's a government study that shows that there will not be a car priced under $15,000, and that includes, accounting for inflation. That's not very pro-consumer at all.
In fact, millions of Americans will not be able to afford new vehicles based on an NADA analysis of the government's price projections.
Our research shows that 7 million Americans who used to be able to afford to buy a new car will not be able to do so because of the cost increases that these regulations will bring.
While the proposal severely impacts entry-level buyers in the $15,000 to $20,000 price range, it affects buyers at every price point in the sticker spectrum.
Let's talk about the family buyer. For example, our study also estimates that over 7 million licensed drivers would no longer qualify for financing to buy the lowest cost family vehicle such as the Dodge Journey, which accommodates more than 5 people or more than 2 child passenger safety seats. This would be devastating for large families or families with small children that would like to carpool.
If they can't afford to buy a car from me at a reasonable price that meets their needs, we're all in trouble.
And in a lot deeper trouble than the government is letting on, as Don Chalmers told the hearing in Detroit.
The proposal dramatically underestimates cost impacts on new vehicles.
The government says prices will rise an average of $3,200 per vehicle.
NADA believes the actual total increase will be even higher.
An NADA analysis finds the government is severely underestimating the cost of its proposal.
We're going to be submitting a study that questions the methodology that was used by the agencies and suggests that the actual cost may be as much as 60% higher than what the agencies project.
That would mean price increases of roughly $5,000 per vehicle, adding more than $100 to the monthly payment.
The first thing that means is that more people will be priced out of the market, either by their own choice or by the unavailability of credit.
The government's 60% price mistake would knock still more people out of the new car market, and the consumers who do buy may never recover in fuel savings the upfront cost they paid for the vehicle.
Secondly, the rule is being justified on the argument that there's a fuel savings payback which more than offsets the upfront cost. However, if that upfront cost is understated and is actually much higher, the payback will take much longer to occur or may never fully occur at all.
The government's proposal is a rush to regulate that is unprecedented.
Dealers are concerned about the accelerated schedule in this proposal.
The government wants to make this decision 3 years earlier than the traditional timeline.
These timelines are the fastest they've ever been.
We question whether setting fuel economy mandates so far out makes sense when critical variables like fuel prices, consumer behavior, and creditworthiness are paramount.
No fuel economy proposal has ever been finalized this far in advance, largely in recognition of the critical, hard-to-forecast factors such as future fuel prices and consumer preferences. By waiting 2 or 3 years, you would better know what the auto market can bear in 2017.
The showroom realities I see suggest that we should take the time to evaluate how consumers react to the higher mileage, higher cost vehicles manufacturers will build in the next few years.
Now is the time to perform this analysis. It won't help dealers and it certainly won't help consumers to have it after the fact when we have sales slowdowns, or after the fact when we've had market disruptions, or after the fact when consumers are not able to afford the vehicles that they want and need.
Dealers embrace the pivotal role we're playing to help lead our nation back to the road of prosperity. But we are wary of anything that might depress sales and turn back the gains being made. Simply put, before rushing headlong into a new set of mandates aimed at doubling today's fleet fuel economy, we need to know better what the ramifications will be.
We need to make sure that federal policy produces a vehicle that is affordable in this country and produces a vehicle that meets consumer demand, that meets the functionality that people want and need.
What people want and need is easy to see on any highway. Families with packed SUVs, bicycles on the back, people pulling boats bound for their favorite waterway, families on a camping trip, people hauling who knows what from here to there, and pickup trucks and vans of all kinds, small business America on the job.
We have to provide for them what they want, not what the government thinks they want, but what they want and what is practical and works for them.
People want the size, durability, and power of today's vehicles.
I enjoy getting out on a farm, going outside, pulling things with my F-350, and this is very much a part of the American way of life.
Again, consumers should have a choice. Fuel economy rules calibrated to meet consumer choice and market demand while protecting jobs and the economy is the only winning formula. And it's the legal formula Congress mandated when it designated the National Highway Traffic Safety Administration to write fuel economy rules. But NHTSA now shares that responsibility with the Environmental Protection Agency as well as the state of California, which is actually driving the process.
Part of the big problem right now is you have California setting standards, EPA setting standards, and we need one national standard where we know where we stand that takes consumer affordability in account, which the EPA does not have to do.
McConnell delivered that same message at congressional hearings last year.
Today, there are 3 different fuel economy programs administered by 3 different agencies under 3 different standards pursuant to 3 different laws. America's auto dealers support a single national fuel economy program under CAFE, beginning in model year 2017, is the best way to increase fuel economy, protect jobs, preserve passenger safety, and reduce vehicle tailpipe CO2 emissions.
Following a Supreme Court ruling, the Obama administration decided that the EPA now has a big say in fuel economy standards. In addition, California can set its own standards based on an Obama administration waiver of the Clean Air Act.
Congress did not intend fuel economy to be regulated by NHTSA, EPA, and California together when it passed the bipartisan 10 and 10 Fuel Economy Act in 2007. It is paramount for Congress to reassert its primacy over this area and return the still recovering auto industry into a single national fuel economy standard.
While EPA's role is troublesome, California's poses the greatest threat. It has the authority to impose stricter standards if it is unhappy with whatever the next national standard is. 10 other states would currently follow suit. That would create a patchwork of laws across the country. It would cause shortages of SUVs and light-duty trucks because manufacturers would have to limit production of them to meet individual state laws. It's a nightmare scenario, and the government knows it.
One of the ironies of this entire debate is that both EPA Administrator Lisa Jackson has admitted that a patchwork would be problematic. And frankly, California has admitted that a patchwork would be problematic as well.
California's position is really a not-so-subtle message. The federal rules better be stiff enough to make it happy, or else.
The unfortunate situation we find ourselves is that California is actually able to dictate to the federal government what those regulations should be because it has the ability to implement its own regulations if it doesn't like what comes out of the national discussions. And that gives that state way too much authority over this issue.
NADA strongly believes that the issues and goals involved in this rulemaking are national in scope, and that California regulators should not be dictating national policy or setting fuel economy standards.
No one state should dictate a national fuel economy standard for the United States.
It should be regulated at the national level, and it should be regulated by a single regulator.
It's a question of who regulates and how they regulate. The who is NHTSA. The how is their statutory standard that takes into account jobs and consumer affordability.
NHTSA is the only agency by law required to write fuel economy rules and consider the impact on jobs, consumer demand, affordability, and vehicle safety. That's why NADA supports it.
The NADA fully supports continuous improvement in fuel economy. In fact, it's because of that support that we're concerned about these rules. We fear that these rules are moving too far, too fast, and as a result, consumers won't be able to afford the new vehicles, which means they won't get the fuel economy improvements, they won't get the safety improvements, and the environmental improvements that these new cars could bring won't be realized.
What's preferable is a market-driven approach that leverages instead of frustrates consumer demand. Such a policy would provide long-term safety, environmental, and fuel economy benefits by accelerating turnover of the fleet of vehicles now on the road.
If we're not selling the car, the fleet gets older, and nobody's getting better gas mileage.
What we want is to accelerate overall fleet turnover. A newer vehicle is going to provide safety gains. A newer vehicle is going to provide fuel economy gains. A newer vehicle is going to provide environmental gains.
Ultimately, the customer has to buy the car for any of these fuel savings to come into effect. And so we're very concerned about that.
The younger the fleet, the better the fuel economy.
We need to make sure that the regulatory policies in this country accelerate fleet turnover rather than delay. Our concern about this rule is it could potentially go too far too fast and in fact delay fleet turnover, which would have the ironic effect of delaying environmental gains, delaying safety gains, and delaying fuel economy gains.
I'm afraid we're going to get just the opposite of what is intended. If they can't find and purchase what they want, they can't afford to purchase it, or the range of vehicles that they want are not there for them, what are they going to do? What would you do? I'd keep what I have.
And collectively, dealers will be stuck with billions of dollars worth of vehicles they can't sell.
If they get the fuel economy regulations wrong, the industry will be compelled to produce vehicles that people don't want to buy, either because they don't do the things they need them to do or they cost too much, and then the dealers will be stuck holding those cars on their lots and not being able to sell them.
NADA has made its case in public at the hearings and will be filing written comments within a few days.
We are in the notice and comment period of the rulemaking. We are asking a lot of questions, but it is important also for Congress to ask the same types of questions of EPA.
NADA urges Congress to reassert its constitutional authority over federal agencies and reestablish NHTSA as the sole regulatory authority for writing and implementing fuel economy standards. What can dealers do?
Ask yourself as a dealer, go to your salespeople, go to your F&I people and ask them, if the average vehicle on your lot today were $3,200 more expensive, how many of your customers would not be able to afford that vehicle?
Then pass that information along to your members of Congress. John Spiropoulos, NADA TV.